Okay, so we want to continue our lesson on the conceptual framework by looking at the other three things that are left to talk about. So we are going to talk about the elements of financial statements, their recognition and measurement, and then we'll look at the concept of capital and capital maintenance, and then finally we look at the reporting entity. And so without wasting much time, let us begin with the elements of financial statements. So let's look at the elements of financial statements. The elements of financial statements. We are also going to look at their recognition and measurement. Now, another highly examinable area in the conceptual framework is the elements of financial statement. Like I said, some students confuse the components that we mentioned in the earlier videos with the elements. Now, the elements of financial statements are assets, liabilities, income, expenses, and equity. So, assets, liabilities, equity, income, and expenses. Now, these five make up the elements of financial statements according to the conceptual framework. The components has already been spoken about. That is the statements you prepare. But the elements are assets, liabilities, equity, interest, income, and expenses. Now, we need to be able to understand these five, to be able to define each of them, explain them, and then you should be able to talk about their recognition and measurement. That is what the conceptual framework requires. Now, what is an asset? The definition of asset, liabilities, income, expense has been treated from the introduction of accounting. Okay, even on my channel. We know the basic definitions of assets. Of course, if you are doing financial reporting up to this level, you have already done a financial accounting and you can define these things on a basic level. However, the conceptual framework gives certain unique definitions for this, even though it is the same as what you know, but the language used in the conceptual framework is different from the language used from the basic principles. And so I'm going to give you how the conceptual framework defines each of these. And then I'm going to explain what you need to understand from that. So that in the exam or in any exam where you meet this, you should be able to write, especially when the question is specific, that according to the conceptual framework, then you need to give the definition that is in line with the conceptual framework. However, if you give your definition and it makes sense, I am sure the examiner wouldn't mind giving you, even though some examiners will be strict on giving full marks to only those who are able to quote the definition from the conceptual framework. Now, what is an asset? Let's begin with that. According to the conceptual framework, what is an asset? An asset is a resource controlled by an entity as a result of past events and from which future economic benefits will flow to the entity. So I'll take it again and I'm going to put it on your screen. An asset is a resource controlled by an entity as a result of past events and from which future economic benefits are expected to flow to the entity. So when you talk about an asset, you are mentioning some keywords in the definition. The first one is the element of control, that it's an economic resource. This resource is controlled by an entity. The second one is that it came as a result of past events. And the third keyword is future economic benefits. In fact, these three are key to understanding when to classify an item as an asset or not on the financial statement. Before you classify any item as an asset, there should be some control of the entity. So the entity must control that particular resource to be classified as an asset. And then it came as a result of past events. In fact, past events is more of like a historical record. There was a transaction that happened to acquire that particular item, and that item should give us future economic benefit. which to me is the most important of all. You cannot classify any item as an asset in the financial statement if it will not give us any future economic benefit. So I told you people in the principles or introduction to accounting that an asset is a resource, economic resource, or properties that are used to generate revenue. That is what I say. So that is what we call future economic benefit. You should be able to get some future benefit from what you call an asset. If there is any item of property in your firm that is not going to flow in or bring in an inflow of future benefit, then we can't classify that as an asset according to the conceptual framework. So that is what the definition of an asset is all about. Resources that are controlled by the entity as a result of past events from which future economic benefit will flow to the entity. That is an asset. And then let's look at the definition of a liability. A liability is also defined as an obligation to settle or transfer future economic benefit from the entity as a result of a past event. So let's look at that on your screen as well. Liabilities are an entity's obligation to transfer economic benefits as a result of past events or transactions. So that is a liability. So there is an obligation to transfer. So when it comes to liability, the key word there is the obligation. That is the first one. There should be an obligation to settle for it to be classified as a liability. This obligation is as a result of a past event. And then the third important thing is that there will be an outflow of economic benefits. The same economic benefit. This time, the first one for the asset is an inflow. Here, there is an outflow of the same future economic benefits. So this time, we are going to pay. So you see, it is the same definition of a liability that you know, but the conceptual framework is using certain key things. Okay, so an obligation to transfer economic benefit as a result of past event. That is a liability for you. So I'm sure you are okay with that. Now let's look at the definition of equity. Equity or equity interest is a residual amount after deducting all liabilities of the firm from the asset. Simple. So equity is basically assets minus all liabilities. And we know this from the accounting equation. And this is how we define equity from the conceptual framework. That equity is defined as is a residual amount found by deducting all liabilities of an entity from all the assets of the entity. So that is simply the equity interest that is in a business. When all liabilities are taken from assets is equity, as simple as ABC. All right, so having known the definition of equity, let's look at the next one, income. Now, the definition of the income and expense from the conceptual framework is quite lengthy, but very understandable. So I want you to look at it from the screen and then we'll explain it. Income is the increase in economic benefit during the accounting period in the form of inflow or enhancement of assets or decrease in liabilities that results in increase in equity other than those relating to contributions from equity participants. I repeat. Now, income is an increase in economic benefit. An increase in economic benefit during the accounting period in the form of inflow. So you see, we are talking about an increase in economic benefit, which is in the form of an inflow. So instead of saying income is just maybe the proceeds that are obtained from the sale of goods and the provision of services, which is correct. Here, the conceptual framework wants to be more specific and then touch on very key things that are important. That it is an increase. So once within the accounting year, there is an increase in your economic benefit. The increase only is not enough to call it an income. But look at the specifics. Increase in economic benefit in the form of inflow of cash or enhancement of assets. So it is not only monetary cash inflow that is income. Sometimes there could be an enhancement of asset like an upward revaluation of a property. That is also an inflow or that is an income, sorry. enhancement of assets, or it could be a decrease in liability, resulting in increase in equity. Because as your liability decreases, then equity increases. Remember that the definition of equity is that asset minus liability. So when assets are going up, equity will increase. When liability is also coming down, equity will increase. So every income must increase equity. So whether it is an inflow of cash or an enhancement of assets or a reduction in liability, there will be an increase in equity. And that is an income. That is the effect of an income. Okay, so look at the definition carefully and then try and get it. Income is an increase in equity. Sorry. Income is an increase in economic benefit during the accounting year in a form of an inflow or enhancement of an asset or decrease in liabilities. That results in increase in equity, other than those relating to contributions from equity participants. So what we are saying is that when any of these things increase equity without an increase in share, there we have not issued any new share. So the equity participants have not made any new contributions, but their equity is going up. Then it's as a result of income. That is what we are trying to say. So the definition looks very lengthy, but you need to break it down and try and understand from how I have explained. So now let's move away from income to expenses, which is the last one. Look at the definition for expenses also on your screen. Expenses. You see, the definition of expense is similar to that of income, but it's in an opposite vein. Expenses are decreases in economic benefit during the accounting period in the form of outflows. You see, outflows or depletions of assets or increases in liabilities. I hope you are getting it now. That results in decrease in equity, other than those relating to contributions from equity participants. So I think the definition of expense is even making that of the income more understandable. This time we are saying that it's going to be an outflow of economic benefit within the year, or it could be a decrease in assets or an increase in liability. And once it's going this direction, it means that equity is also coming down. So if you look at it carefully, decreases in economic benefit during the accounting period in the form of outflows or depletions of assets or increase in liabilities, that results in decrease in equity, other than those relating to contributions from equity participants. That is an expense according to the conceptual framework. And so I know that because of the lengthy definition of these two, many students will prefer to write what they understand. But it is always good that you'll be able to get this and then produce that for the examiner. And I'm sure that there will be no cause to reduce your marks if you deserve that. Okay, so these are the elements of financial statements. Now, I told you that it is not just the elements of financial statement that is dealt with in the conceptual framework, but their recognition and measurement. So we are briefly going to talk about recognition and measurement of the elements of the financial statement. Okay. When it comes to the recognition and measurement, there are two different things. Recognition is different from measurement. Recognition is different from measurement. They are not the same. Now, let me define the two for you. Recognition means you are incorporating the item of asset, liability, income, or expense into the financial statement. Now, take note that the equity is coined from liability. I've explained to you from the business entity concept that equity belongs to the owners of the business. And these owners, if you apply the business entity concept, then they are separate from they are separate entities from the organization. Therefore, whatever money they have provided, we see that they are also like creditors to the business. So the equity is a special kind of liability, but it is separated because it relates to the owners. So when I talk about recognition and measurement of a liability, the same will apply for equity, because the conceptual framework really didn't talk about recognition and measurement for equity. It talks about asset, liabilities, income, and expense. But we know that equities fall in line with liabilities. That is what I want you to understand. Now, when we talk about recognition, recognition means you are incorporating the item of asset, liability, income, and expense, any of them, you are bringing it onto the financial statement, then we are saying you are recognizing it. Measurement means assigning monetary value to the asset or liability or income or expense. So you are assigning monetary value, you are measuring it, then you are incorporating it onto the financial statement, you are recognizing it. And the conceptual framework talks about these two, recognition and measurement. Of course, you cannot recognize it if it cannot be measured reliably. So for all the elements of financial statement, one of the recognition criteria is that it can be measured reliably. Because you cannot recognize what you don't know. Assuming that I want to recognize this asset on my financial statement, what monetary value am I going to put there? Because the financial statement should reflect monetary values. Okay, so when it comes to recognition, we have the recognition criteria for assets, recognition criteria for liabilities, recognition criteria for income, and that for expenses. And I just want to take you through each of these recognition criteria. When it comes to the recognition criteria for assets, there are two key things to talk about. The first one, when it comes to recognition criteria, so let's begin with the assets. The key thing is that it is probable, there is a high probability that future economic benefits will flow to the entity from the use of the asset, and that the cost of the asset can be measured reliably. Okay, so let me just put the recognition criteria on your screen. When it comes to assets, you can see that an asset is recognized if it gives rights to future economic benefits controlled by an entity as a result of past events. So like I said, future economic benefits will flow to the entity from the use of the asset, and then the cost of the asset can be measured reliably. These are the two key, okay? When there is a high probability that future economic benefits will flow, then you recognize it, and that the asset can be measured, the cost of the asset can be measured reliably. So there should be reliable measurement as well. That is where measurement comes in. And then there is also evidence of its existence. So this it can be three. So we can talk about the flow of future economic benefits, the measurements reliably, and then we can also talk about there is sufficient evidence of its existence. So that is the recognition criteria for assets. If you look at the liability, you can see that is similar, that there is an obligation to transfer economic benefits as a result of past events. Okay, so that one, when the assets recognition criteria is that there will be an inflow of economic benefit, the liabilities recognition criteria is that there will be an outflow of economic benefit. But for both of them, there should be measurement of cost reliably. So it can be measured reliably. And then there is also sufficient evidence of its existence. Now let's look at the recognition criteria for income. I'm going to put that on your screen because I'm not writing these things on the board because of the length of the words. Now, income is recognized if an increase in future economic benefits arise from an increase in assets or a reduction in liability, like we said. And then the second one, that the increase can be measured reliably. So you see that for all these criteria that we are talking about, there should be a reliable measurement of the element. And that is important. So its measurement should be reliable. The value that you assign for the asset, liability, income, and expense should be reliable. There should be reliability in there. And then also, it also satisfies the definition of the element. So you see that the first criteria is all satisfying the definitions we said. And the second one is about measurement reliably. I think that should guide you, should be able to write the recognition criteria. Then if you look at the expenses finally, you can see that expenses is recognized if a decrease in future economic benefits arises from a decrease in an asset or an increase in liability. So you see that the first recognition criteria is only meeting the definition we said earlier. And the second one is that the decrease can be measured reliably. So you can see that for the recognition criteria for the elements of financial statement, even if you forget anything among them, you remember that there should always be a reliable measurement. And then the other one should always be meeting the definition. And then some, you need the sufficient evidence of its existence. So take your time and go through the recognition criteria for the element of financial statements. Now, when it comes to measurement, I'm going to talk briefly about measurement and then we move on to the concept of capital and capital maintenance. Now, let's look at the measurements of the elements of financial statement. Now, I've already explained measurement to you as assigning monetary values to the elements of financial statement. Now, the conceptual framework permits 4 different measurement bases. Okay, the conceptual framework discusses 4 different measurement bases, and I'm going to list them for you. The first one is the historical cost basis. And then the conceptual framework also discusses the current cost or the current value basis. In fact, these are the 2 key ones, okay? These are the 2 key ones that are discussed in the conceptual framework. But there are other 2 that it also talks about. That is the present value and the realizable value. Now, these are the measurement bases, okay? So an organization can decide to measure the elements of their financial statement with any of these bases. I have split these 2 because I'm going to explain something here for you to understand. Now, historical cost method. When we talk about the historical cost, we are only trying to tell you that the asset is being measured or on the financial statement on or using the amount that it was bought for. So historical cost is basically how much did you buy it for? Just use that to measure whether there has been a change in the value of the asset on the market or not. Just put the amount you bought it on the financial statement. So assuming I bought this thing for 3 cedis or 3,000 Ghana cedis, and then in the following year, the value has gone up on the market to be 6,000. I cannot now put 6,000 as the value of this on my financial statement because I bought it for 3,000 when I was buying. That is the historical cost. We are looking at the history when I bought it. Okay. Now, that is contrary to current cost. Because if I was using the current cost, then even though I bought it for 3,000, but I'm going to recognize it this year for 6,000 because it's the current value. I hope you are getting the difference between the historical cost and the current cost. Because when it comes to the current cost, we are going to, that is where we apply the fair value model and then the value in use and then the others that you know. So when it comes to the current cost, we consider the fair value of the asset or the value in use of the asset. All right. So historical cost, how much you bought it should be there, regardless of the changes on the market. But current cost, even though I bought it for so little, now the value is so much. So I have to update the records in my book with the new current value of the asset. And we can, how do you get the current value? You can use the value in use as your current value. You can use the fair value also as a current value. That is when you have done a revaluation and you realize that it has gone up. Then you are measuring the elements of financial statement based on the current cost. Then these 2, even though it's not really in use, but it's also basis that you can use to recognize the element. The present value. Present value is basically the value in use. That is why I'm saying that these 2 is the most important because the value in use is discussed under the current cost. However, present value is basically value in use. When you discount the expected future cash flows of the asset and then you use that to value the asset, that is your present value. So basically, the present value is more also under the current cost. And then the realizable value. Realizable value is valuation of the item of or element of financial statement based on how much it can be sold for. So if you hold an asset, even though you bought it for let's say 3,000, current market value may be 6,000. But if you know that when you want to sell it today, you can sell it for 8,000, you are sure, then you can value it in your books for 8,000. So now you are going to recognize it in your books at the value that you can sell it. That is a realizable value. So I think these are the differences with the measurement basis. And an organization can use the measurement basis that is best justified. Remember that there is oversight. So when auditors come, you should be able to justify what you have done to them. So these are the measurement basis of the elements of financial statements. Okay. All right, so let's talk about the concept of capital maintenance. The concepts of capital and capital maintenance. Now, I'm not going to waste time with the capital maintenance. Okay. When it comes to the capital maintenance, there are two main capital maintenance approach that the conceptual framework talks about, and I'm just going to give you an explanation briefly. The first one is on financial capital maintenance. And then physical capital maintenance. Financial capital maintenance and physical capital maintenance. Now, I'm going to explain to you and I'm going to help you to understand it from the angle of profit measurement. Okay? So, how does the organization say they have earned profit under the financial capital maintenance? Because when you are maintaining your capital, it means that the capital is not going to deplete, but you want the capital to rather increase. Now, when your equity or your capital is increasing without any additional input from the owners, then we can say that you have earned a profit. Okay. Now, how is profit earned under the mindset of the financial capital maintenance and under that of the physical? Now, this is the difference. Under the financial capital maintenance, I don't know if you have watched my video on single entry and incomplete records. I explained the net worth method for finding profit in a situation where there are no proper record keeping. Now, the closing capital and the opening capital, when you take the opening, let's assume that the net worth at the beginning of the year is $1,000, and then your net worth at the end of the year is 1,400. Then what has happened? You have increased your capital by 400, and that is profit. This is the concept of financial capital maintenance. We are saying that profit is earned if the value of the firm at the end of the year financially is more than the value at the beginning. Then you have added something, that is profit. That is the financial capital maintenance ideology. On the other hand, when we come to the physical capital maintenance, we are more focused on productive capacity rather than the financials. Productive capacity. Let's say you have a machine that could produce 2,000 bags of cement at the beginning of the year. So, beginning of the year. And then at the end of the year, the same machine has a capacity to produce 2,500 bags. Then you have earned productive capacity profit of 500. So what has changed? That the same machine that was producing 2005 and 2000 at the beginning is now producing 2005. So this is the concept of physical capital. So when it comes to capital maintenance, we are saying that if the machine is producing 2000 bags, at least, even if the production capacity is not going up, it should never fall. Once you buy the machine that produces 2,000 bags a day, and then with time it's now producing 1,009, 1,008, then it means you are depleting your capital as far as your physical capital is concerned. Financially, if you were making 1,000 profit a day, and then now you are making 800, you are depleting your financial profit. So what we are trying to say is that we rather want to increase or maintain. And that is the concept of capital maintenance. That at every point in time, the organization should strive that financially they are rather going up in terms of their profit-making capacity. And then productively, the machines are also more efficient than they used to be. This is the concept of capital and capital maintenance. I would plead with you to take time and read around this, and then I'm sure from my explanation, whatever you read, your understanding will be enhanced. That is the concept of capital maintenance. Okay, so the final thing to talk about with the conceptual framework is the reporting entity. And this, there is nothing much to talk about this. I mean, this was a concept that has been officialized. It was recently officialized in 2018 by the International Accounting Standard Board. Now, when we talk about the reporting entity, it's simply the entity that must prepare financial statement or chooses to prepare financial statement. And it comes in three categories. We have the single entity. So a single entity can prepare financial statement or a portion of a single entity, a portion of an entity. When we say a portion of an entity, we are talking about the divisions, okay? It could be strategic business units, okay? A portion of an entity or more than one entity or combined business. That is a combined business, like a group, a parent with their subsidiaries and all that. So the reporting entity, a conceptual framework specifies these three as the three key reporting entities that must or chooses to prepare financial statement. So we can have a single entity's financial statement. We can have a portion of an entity preparing its own financial statements, and that is acceptable. And then we can have a group combining to prepare financial statements. And that is why we have consolidated financial statements, and then we have separate financial statements. And then we have departmental financial statements because the conceptual framework permits it to be so. Okay, so there is nothing much to talk about with the reporting entity. I think that this will bring us to, I think, the end of our explanation of concepts with the conceptual framework. The next video that will come on the conceptual framework will be to discuss questions. Okay, questions, likely questions from ACCA, ICAJ, some master's degree of some top universities, undergraduate studies, and then diploma, so that we'll be able to look at the perspectives and how examiners expect you to answer questions. Remember to subscribe to this channel if it's your first time, share this video, and let others also have a benefit. And until we meet again for another video, it's bye for now. Thank you.